Hey, good morning, everyone. Marty Mazzora here. It is the 29th of February, 2024, Thursday, end of week market snapshot. Clients, it'll come attached to an email tomorrow as Friday's message. A few things I want to cover today. We'll look at the charts, but I want to look at them from a little longer term perspective than we have the last few weeks. Take a look at breadth again. We'll skip sentiment. It's still robustly bullish, which is a contrarian concern for the market, as we've illustrated a lot over the last few years. And we'll touch on yields and the dollar and talk a little bit about today's data. But I thought I'd start with the morning written note that clients and blog subscribers received this morning, and we'll just kind of summarize the points I was making here. So I titled it, "Will Wall Street Get What It Wants?" And I said I couldn't agree more with the first line from my Jim Bianco quote, and that is, Wall Street forecasts what it wants. It doesn't forecast necessarily what's going to happen. It forecasts, again, what it really hopes to happen. That's been my experience over all these decades of being in markets. Now, sometimes it gets what it wants, and it appears prescient. What Wall Street wants right now is lower interest rates. They want it because 5% money market rates are competition for the stock market, according to very good analyst Jim Bianco, founder of Bianco Research. So Jim's pretty bullish on the economy this year. So he thinks rate cuts are 0 to maybe 2, but right now he's leaning towards 0. So he does not see recession coming this year. Then there's the likes of Peter Berezin, who was very lonely in the no recession in 2023 camp and a bull on stocks in 2023. I say very lonely because the overwhelming consensus was that we were going to have a recession last year. So this is something he offered up Friday. The U.S. consumer is in great shape, except that credit card delinquencies are at their highest level since 2012, back when the unemployment rate was 8%. Credit card interest rates are at record highs. Banks are increasingly unwilling to make loans. And that pandemic savings, the leftover money that was given away around COVID, has been largely wiped out, and the savings rate is half of what it was in 2019. So he's being facetious here, obviously, when he says the consumer is in great shape. And Peter is pretty much flipped. He sees a concerning chance of recession second half of this year or first part of 2025. And then he's got some charts essentially on delinquencies and on interest rates and senior loan officer surveys, what they're saying about tightening credit standards, estimates on the pandemic savings, as it's called, on savings rate coming down, and so forth. And then there's what I said on Monday. As for the time being, recent hotter than expected CPI and PPI, potentially PCE this week, and we'll take a quick look at that in a minute. Notwithstanding, I do believe that before the current cycle runs its ultimate course, those who, on behalf of their stock positions, are praying for dis or deflation will indeed see their prayers answered. So I'm honestly in the Peter Berezin camp, folks, not in the Jim Bianco camp right here. So I'm saying that Wall Street is going to get what it wants ultimately. Now, thing is, though, beyond the rally that I'm sure will come as cooler inflation data shows up and the Fed starts talking sweet to markets again, there's this F word, right? And that F word is fundamentals. So here I talk about profit margins. So think about it, folks. With inflation rising, right, and consumer still partaking in their revenge spending, so to speak, well, you've got companies making money. They have the pricing power to raise the cost of their wares even above the rising cost of labor. So now if inflation's ultimately coming down, then the overall pace of price increases is by definition coming down as well. And if recession indeed arrives along the way, still our base case, we're not just talking about the pace of price increases, we're probably talking about outright price declines. in many venues. And those venues or companies or sectors or industries where, for one example, the cost of labor has risen at an historical pace these past few years. So again, my point being that the pricing power goes away, but the cost of many inputs, the biggest being labor, doesn't. And then what happens to profit margins? Of course, they shrink. And what happens to stock prices that are essentially pricing in never shrinking profit margins going forward? And then what happens to jobs in general when companies who, CEOs are ultimately concerned about their stock price begin seeing margins shrink? And then that's, just feeds the whole recession narrative. These things unfold slowly. They say that Fed action comes with long and variable lags, to quote Milton Friedman. And essentially what he's saying there is, when you tighten policy, it's not overnight that the market begins to react to it, or the economy does. Particularly when you throw in, trillions of fiscal stimulus. And I talked last time about the uniqueness of 2023, where you had huge fiscal spending or fiscal impulse and a hugely aggressive spending consumer at the same time. Usually they offset one another. They were both working in tandem for the economy this last year. And of course, now we've got some inflation to continue to contend with. So let's get to the particulars in terms of the technicals and, as I said, breadth and so forth. So I wanted to throw back 3 years or so here on the chart where I'd capture the previous all-time high, and this is for the S&P 500, the cap-weighted index that everybody looks at. Remember, right in here, this was the previous all-time high, and we had your rising wedge pattern that I like to draw. Had some very bearish divergences. We were overbought with a bearish divergence on the RSI, and we took about a 27% hit in 2022. Remember, we were flagging the bottom in here. I was showing you the technicals looked pretty compelling, right? You had a longer bullish divergence here on the momentum, and you got a nice pop here. Problem is, our recession light was lit, so we didn't engage to the extent we would have if we thought the macro long-term was favorable for stocks. And then along the way, you've got these short-term, buy and sell signals, and they pretty much for the most part played out. Times when they didn't was when the AI stock craze happened last year and last week or so as well. And then here we were with that that double-digit correction from July to the end of October. We were flagging this big time. I had these circles drawn there at the time, and I was showing you bullish divergences. And I said odds favor a rip-roaring, rip-your-face-off Santa Claus rally. That's what we got. Problem is, folks, if you're a thoughtful long-term investor, you're looking here at these marginal new highs, and you're looking at a nice uptrend there, a little bit of rolling over here, almost into a wedge. But man, we've got these real bearish divergences that we continue to contend with, coming off of overbought. Looks like a very heavy market. Maybe it needs a catalyst. Didn't get it today with the PCE numbers. Didn't get it earlier with the NVIDIA earnings numbers, which a lot of the bears were anticipating. But, my experience is it doesn't need to be a big catalyst if the market is really overbought, really heavy, and needs to correct. And that's what this chart at least looks like right here. As for the NASDAQ 100 index, and this is the ETF that tracks it, same kind of stuff. More of a rising wedge. We actually did break down, and we haven't recaptured the trend line here, so that's pretty bearish. Big, long divergences, bearish divergences here on both the momentum indicators that we look at. And, just same kind of stuff. Bottom made sense right in here. But, man, this looks really, really toppy to us. As for the Russell 2000, it is still a long ways, as you can see here, from its all-time high, good 15+% still. And, we were pretty constructive on it in here, as I illustrated in the videos. But as you can see now, you're right back about where you were here in December. And massive bearish divergences on the Russell. It's having a pretty good day today, or it was earlier. It's given up most of its gains as I speak. The S&P was up pretty nicely. It's now slightly in negative territory. And the NASDAQ 100 is pretty flat. So this market rallied this morning on not as hot as people had feared PCE data, But again, we'll go over that here in a minute. It looks like right now it's given that back. I mean, we could be rip-roaring again by the close. This is all short-term stuff. And then just a quick one on breadth. So the blue line is the S&P 500 cap-weighted index. The white line is the S&P 500 equal weight index. The orange line is the NASDAQ 100 equal weight index, right, or ETFs that track these two. Do the blue line here to show you that we are above the previous all-time high, new all-time high territory. But when you just equal weight everything, you give each component equal measure in the index, you can see that we're still 5 or 6% below on the equal weight, it's all-time high, and that much, a little more than that here, the NASDAQ 100 equal weight. So folks, when you just look at stocks across the board, no, this is anything but a rip-roaring new bull market, to put it mildly, frankly. And then more on breadth, the percentage of stocks currently trading above their 50-day moving average is 65% of them, so 35% aren't. And we are, again, moving steadily into new all-time high territory. And this just gives you a look at what these patterns tend to portend, right? So here we were right before COVID. Breadth was already rolling over. You can see we had a long bearish divergence, 35, whatever it was, percent hit. It was quick because they threw trillions at it, right? And then, here we are melting back up, some corrective action. So these are pretty good, not short-term trading signals, but just kind of signals that, hey, this thing's heavy, and here we were at the previous all-time high. Here we are at new highs, and we have fewer stocks trading above their 50-day moving average. Again, folks, these just aren't hallmarks of healthy markets that are about to really take off and be meaningful on a durable basis. Same thing with the 200-day moving average or the stocks above that. The breadth chart that should keep the bulls up at night would be the NASDAQ composite breadth chart. This is as ugly as I've ever seen it. So here we are, eking into new all-time highs, and here's a NASDAQ composite advanced decline line. It is a mess, and you can see what it looked like before the previous peak, and that was a 38% decline in 2022, folks. And here it was before this one, and I could take you back further. This is the one that has a ton of work to do before it alleviates the signal that you're getting here. So I'll continue to show that either until what looks like is ultimate, based on this chart, comes to fruition. And we're looking forward to being buyers of a lot of things if many of these patterns play out, or we can be buyers later on, even at higher levels, if conditions allow us to be. As for the 10-year yield, obviously the way things are trading, if this breaks down, it's bullish for stocks. If it breaks up, it's bearish. Interestingly, it's breaking down today. Long-term bonds are seeing quite the rally. You can see this is the yield on them. It's going down. And for most of the morning, stocks were up, and they're pretty flat right now. Interesting. I would say that this is a reaction to the relatively tame, relative to expectations, PCE inflation data that came out today. And again, I'll show you that here in a second. The dollar, on the other hand, is having a pretty good rally so far this morning. I mean, it's not up huge, but it's up. It's up against the grain. I said yesterday that if yields were to spike, the dollar would too. Or yields are rolled over, but the dollar has spiked. Anyway, the euro is pretty weak this morning. I looked across euro data. The only thing that really supported that I could at least see right off the bat was that French PPI, Producer Price Index, was down a bunch relative to expectations, but CPI was kind of hot and GDP was okay. But who knows? There may be some other news there that's guiding the euro lower. And the euro has the biggest influence on this DXY, which is the dollar index. So I think it may be more about the euro than it is the dollar. However, I will say that when I look at the data that came out this morning here in the U.S., when you look at personal income, was very interesting. So you can see personal income was month over month expected to be up 0.4%. It was up a whopping 1%. Okay. Now, consumption expenditures, consumer spending was right on expectations at a 0.2% month over month. Now, this gets explained away, apparently, when you look at the internals. High dividend income, dividend payouts in January seem to have an impact, at least that was in the breakdown. And then government transfer payments tend to pop a bit in January. So some of that was going on. So the market maybe just poo-pooed this, as nothing to worry about. But again, if you just looked at that, it would make sense that the dollar would be higher, but it would also make sense that yields would be higher, and they're not. I told you what spending was. The price index month over month, 0.3, right, was exactly what was expected. Year over year, 2.4. Simply math, came in right where it was expected to be. The PCE core, which X's out food and energy, 0.4. That sounds like a lot, but it was at expectation. Some people thought it would be 0.5. I think the market would have rolled over pretty hard if it came in at 0.5. And then 2.8 year over year. So there's nothing that freaked anybody out or any market participants about today's PCE data. But then we had jobless claims, and again, jobless claims were actually higher than expected. I think they're like 15,000 above the previous week, so that would speak to yields dropping here, but it wouldn't necessarily speak to the dollar. Again, I suspect maybe that's more about the euro than it is about the dollar. So folks, just mixed signals galore. And, again, just going back to this original S&P 500 chart, having done this for years and years and years, I made it very, very clear we can be raging bulls when the fundamentals and the technicals point in that direction. I love Cole Moshe's quote that I've probably quoted 100 times over the years. He's a well-respected, I think retired now, hedge fund manager. He said that, there's the wind and the tide. And if all you do is focused on the wind, you're going to end up crashing into the rocks. So the wind, to me, is the technicals. The tide is the underlying fundamentals. You could say the wind is the price chart. And even here, the underlying technicals are saying something concerning to us right here. Could the wind change direction and blow us away from what looks like maybe a straight course into the rocks? 100% it could. And that will show up. It'll show up in the data. It'll show up in our charts. And I will be happy to tell you a much more optimistic story. Just can't tell you it right here, despite what you see when a company like NVIDIA blows out earnings, or a day like today where inflation is still considerably above the Fed's target, but it wasn't what the market ultimately feared. So I'll stop rambling there, folks. I appreciate you. Thank you, as always, for watching and listening. Talk to you again soon. Bye-bye.